The IRS just quietly rearranged the furniture, and most people are gonna walk right into the coffee table in the dark. We're not talking about rate hikes, dramatic legislation, or some political showdown they just moved the lines. And that small shift changes everything about how your next dollar gets taxed in 2026. Here's what actually happened. The IRS adjusted the 2026 tax brackets for inflation, which sounds boring until you realize that adjusting the lines is the tax equivalent of moving the goalposts while the game is already in progress. If your income stayed the same but the bracket thresholds crept upward, congratulations, you just got a quiet, invisible raise that most Americans will never even notice on their pay stub. Think of it like a highway with speed limit signs that just got bumped up by 5 miles per hour. The road didn't change, your car didn't change, but suddenly you're driving legally faster without doing anything differently. That's bracket creep working in reverse. And for once, it's technically in your favor, but only if you know how to drive. The average W-2 earner will glance at their withholding, shrug, and move on, and that's exactly what the system is designed for them to do. But high earners, business owners, and real estate investors who actually understand income architecture, they're looking at this like a chessboard just got flipped, and a few pawns quietly became queens. Here's the part that should make your stomach drop a little. The difference between someone who gets this and someone who doesn't isn't intelligence, it's intention. Sloppy income planning in 2026 doesn't just cost you a few $100s. It could mean tens of thousands of dollars flowing directly to Washington instead of into your wealth engine. Let's talk about what income control actually looks like in practice, because this is where the real money lives. W-2 income is the least flexible, it shows up, it gets taxed, and there's very little you can do to reroute it once it's sitting in that bracket like a car stuck in traffic. Business income, on the other hand, is a different animal entirely. It can be shaped, timed, deferred, and structured through entity design in ways that W-2 earners literally cannot access. The self-employed person or business owner who hasn't reviewed their entity structure going into 2026 is essentially leaving money in a pile on the sidewalk with the IRS's address on it. Then there's real estate, which has historically been one of the most powerful legal income sheltering tools available to everyday investors, not just the ultra-wealthy. Depreciation alone can create what looks like a loss on paper while you're actually building net worth, which is the kind of financial illusion that, when used correctly, is completely legal and devastatingly effective. Roth conversions are another lever that most people treat like a trap, but should be treating like a timing tool. If your income is temporarily lower in a given year, maybe you had a bad quarter, a business transition, or a strategic gap converting traditional retirement funds to Roth, during that window is the tax equivalent of buying low and holding forever. Now, let's address the misconception that this stuff is only for rich people with accountants on retainer, because that narrative keeps middle-class earners paralyzed and passive. A real estate investor with 2 rental properties, a side business, and a basic understanding of entity structure can implement a legitimate tax strategy that outperforms what most high-paid corporate employees are doing by default. The historical lesson here is simple and borderline embarrassing in how consistently people ignore it. The investors who built generational wealth didn't necessarily earn more, they just kept more through disciplined, boring, repeatable tax planning. Volatility in markets is inevitable, but a sloppy tax strategy is a self-inflicted wound, and unlike a market crash, it's completely within your control to avoid. Position size matters in investing, and income positioning matters just as much in tax strategy. Don't try to optimize everything at once, but do pick one lever and pull it intentionally this year. Whether that's maxing a SEP IRA, restructuring how your business pays you, or running your first real estate depreciation analysis. One move made with discipline beats 10 moves made with anxiety. The philosophical truth underneath all of this is that the tax code is not a punishment, it's a system. And systems reward people who learn the rules. Discipline, consistency, and sizing your strategy to match your actual situation will always outperform the person who's waiting for the perfect moment to get their financial house in order. You don't have to fear the 2026 brackets, you just have to decide whether you're going to read the scoreboard or actually play the game. The IRS will absolutely draft a tax plan for you by default, and I promise you, it will not be written with your best interests in mind. If you're ready to stop letting the system decide for you and want help getting started, whether that's real estate investing, connecting with the right contractors, or finding the right lenders, check out our links in the description below.